Good morning. This is Arlan Suderman, Chief Commodities Economist with StoneX, and it's about 9:42 a.m. on Tuesday, April 29th. It's President Trump's 100th day in office, and I thought it appropriate to take a look at where we stand in the tariff war on this 100th day, since there's a lot of people who are taking a look at things now as we celebrate or mark whichever side you're on that 100th day. Overall, as we look at the commodity markets this morning, we're generally weaker. Worries about economic slowdown, reduced demand for commodities, generally causing a sell off across the board into commodities. Soy oil and soybeans had been what was holding up the soybean complex on anticipation by some in the marketplace. We didn't share that view, but by some that we would see an announcement from the U.S. Environmental Protection Agency on the updated biomass diesel production mandates going forward. And that simply didn't happen. We felt like that announcement would come later in May, and we still believe that that will be the case. But there had been rumors that it would come out last week. It did not. And now we're seeing a disappointment sell off in those markets. And that's kind of contributing to weakness in corn and wheat as well. Overall, because when we look at those markets, which have kind of gone back to trading supply and demand fundamentals that are being impacted by rains in areas that were previously dry and dryness in areas that were previously wet, generally favorable. And we saw good planting progress for the U.S. corn and soybean crops over the last week. We've had moisture in areas that needed moisture. And that now, as we go forward in the next week, we should see a rapid planting progress across the Midwest. Now, there will be some concerns, I think, if that forecast stays dry for the Midwest, which is a real possibility we'll need to watch. But for now, it's kind of rapid planting progress and support for good yields. And Brazil's crops are looking like they're coming in good as well. But overall, as we look, and I should mention that in the energy markets, we're seeing crude oil work lower back down toward that $60 level. That's an area, that $60 to $62 level is an area of break even for the shale oil fields. It depends on whether you're a large producer or a small producer. So there is some difference between producers. But generally, we're in an area now where production gets cut back. But today's focus is on demand and fears that a global economy is going to hurt demand overall. And that's providing some weakness for the markets. It's day number 20 in the 90-day pause on President Trump's reciprocal tariffs. The clock is now ticking. And the major stock indices, it's interesting to note that while they were trading mixed today when I started this recording, that they're generally near the high end of the range that we've seen since April 3rd. That's when the plummet started in the stock market. And we're near the high end. Now, that doesn't mean we can't go lower. That doesn't mean that we're going higher. But what it does suggest is that the markets are adjusting. They're adjusting to what we know. And what we know is negotiations are going on with a number of countries, and that the White House continues to say we're close to some significant trade agreements. India and Japan are two countries that are mentioned most frequently. President Trump needs those agreements soon to maintain the momentum in this fight with other countries to get them to lower their tariffs and their non-tariff restrictions. So day 20, 70 days to go in the pause. He's indicated there won't be another 90-day extension. It needs to happen. So that's what we're focused on. Now, we're going to have a flood of new data coming in. We are starting to see from some of the various reports coming out, Purchaser Managers Index, Fed district reports on manufacturing, etc., that input costs are going up. And so these are being passed on in many cases to the retailers. So manufacturers reporting higher input costs as a result of the tariffs. So it does look like that inflation aspect is coming. Will it be kind of a temporary increase or will it be a more sustained increase? That's an unanswered question at this point. We have a jobs report for the month of April coming out at the end of this week. Those numbers will be a product of the establishment survey and the household survey. Both of those surveys were taken the week after the reciprocal tariffs. A lot of uncertainty in the business community and even among consumers, households, when those surveys were conducted. So there is an expectation that they will show a reduction in jobs created in the month of April. The average trade guess is 130,000 jobs created, but there is a whisper number or a sense that it could be lower than that, with some even fearing that it could be a negative number. So we have to get by Friday's report, which will kind of help set the tone going forward. Now, the primary focus this week, in the absence of any major trade agreement announcements, has focused on China, where we've seen these massive reciprocal tariffs. Our reciprocal tariffs on them are 145%. Their retaliatory tariffs are 125%. Now, ironically, what we're seeing is China very quietly exempt products that they need, that they can't get elsewhere unless at a very much higher cost. And so they're exempting them. This morning, they exempted ethane very quietly. We know that previously they've exempted some pharmaceuticals, some microchips, some aircraft engines, other things. We saw this during Trump 1.0 as well. Very quietly exempt. So the people in China, where the message is controlled, have the sense that President Xi Jinping is standing up to the bully of America. But quietly, while he has 125% retaliatory tariff on U.S. products, he's exempting those things he needs to buy. And we saw some more soybeans sold to unknown destinations this morning. Was that again Sinograin buying some more soybeans? They've been quietly buying some soybeans, not a large quantity, but believe those are going into their reserves. Now, Sinograin, a state grain buying agency, is it paying itself the tariffs? In other words, it's essentially immune from the tariffs. So it can buy those soybeans, put them into the reserve, and then in the fourth quarter of this year, it can auction them off to the crushers, perhaps at a profit if prices are low in the Chicago Board of Trade, because we're not selling soybeans to China. So that's a possibility as well. But overall, the grain and oilseed markets are focused on current fundamentals of, is it raining in key areas, is it not raining, how's the planting going, etc., which I addressed earlier. One thing that's interesting to note is that Amazon has told China restart shipping products to the United States. We're going to be selling those, and we're going to pass on the cost of the tariff to the consumer, and we're going to put on the price an asterisk that says what the amount of the price, at least this is what's being reported, what is the increase in price due to the tariffs. Now, that doesn't indicate what the consumer is willing to buy. Meanwhile, other retailers are starting to look for other sources, bring production of products home, looking for American-made type of products. So this will be interesting how it plays out. But the bottom line is, if consumers don't buy, which in many cases they will not, then you're hurting demand in China. That's hurting manufacturing. We've already seen reports of up to 16,000 layoffs in some of the manufacturing districts in China. Now, the biggest challenge of this tariff war is to China's manufacturing sector. Keep in mind, its economy is built on exports. It's trying to switch that to a consumer-based economy like we have in the United States, but their consumers are scared right now. They're not buying either because they don't have confidence in the economy. So what the government is having to do is go into debt, which it usually puts on its local governments, to stimulate spending by the consumer, to support the economy, to create jobs to replace those that are being lost, to do retraining programs, etc. And so if you look at some of the data that is out right now, and this is at a time when direct foreign investment is coming off, is coming down as well. China's local governments issued 1.24 trillion yuan, that's the equivalent to $172 billion, of new bonds in the first quarter of the year to do the stimulus. That's up 47% on the year. Those local government bonds rose to 437.5 billion yuan, $60 billion in March alone this year, up nearly 24% on the month and up 66% on the year. Now, China's Ministry of Finance data shows that outstanding local government debt stands at 50.165 trillion yuan. That's $6.87 trillion as of the end of March, which is up by more than 20% year on year. Yet, I believe that this is a fight that China believes that it needs to fight. And while China continues to say there are no negotiations going on with this Trump administration, the Trump administration says we're talking. Now, what do we believe it's happening? We're seeing indication that there are talks happening, but they're happening at a very low level. The low level that's talking about how to have the negotiations, so to speak, not levels that'll actually create negotiations. So, in essence, both sides are right. But we feel like China feels like it's going to win if it simply outweights the Trump administration, and feels like if the Trump administration loses political support and has to give up on this, then China wouldn't have to give up anything. It's worried about what it might have to give up if it actually negotiates. Now, I believe that China's being hurt worse than it's giving on, maybe even worse than it realized. And when you look at a trade war, the country that loses is hit the hardest is the one with the trade surplus. And China has a giant trade surplus with the United States. In fact, with much of the world, it has a big trade surplus. But for now, I don't expect a trade agreement with China anytime soon. President Trump needs some other trade agreements with other major trading partners to maintain the momentum. Otherwise, it'll continue to embolden China. So that's it for today on this 100th day of the Trump administration. And I wish you a happy trading day, and we'll be back with you later this week.